I think that we can start now. So welcome everyone. Good morning, good afternoon, or good evening. It's my pleasure to welcome you to the e-axis seminar. It's been 1 year now that we started this series of seminar, and then we have organized 20 presentations since then, all about macroeconomics, climate change, and finance. And we are really happy that you are continuing to follow this seminar. And then we also have, as you know, our Slack community, which is now amount to about 200 members. So I also encourage you to join this community. It's the last seminar before the holiday break, and then I'm happy to tell you that the form will evolve a bit after summer and already now. So in order to capitalize with the success of this webinar, we would like to capitalize on it and make again a significant contribution to the research on climate change and macroeconomics. So we've decided to fund a new non-profit research organization, the e-axis Forum, always with the aim to bring together academic economists and policymakers who are working on policies toward achieving a sustainable economy. And I'm happy to tell you that after the holiday break, on August 31st, we will officially launch this new organization with a virtual event. And in this virtual event, we will have presentation by Stefan Cecchetti from Broeders University, Rick van der Ploeg from Oxford University, and they will present their work and what they think. But we will also use this official launch to present you 2 research projects that we are currently working on. And you will find more information as well as how to register on the link in our website. I think we will post the address on the chat now. That being said, it's my pleasure today to welcome Dirk Broeders from the DNB, who will speak about climate risk and its consequences for central bank risk management. It's, as you probably know, a very timely topic. How central bank can manage climate risk has been a question in the center of the ECB strategy review from the ECB, which presented its conclusion last week with a lot of measure for climate risk. So just before turning to Dirk, let me just tell you, for those who haven't followed what the ECB announced, several measures have been announced regarding climate there. And I would like to reflect a bit and turn back on the process on how these measures have been decided during the 1-year exercise of the strategy review. So there were basically a lot of issues discussed about monetary policy operation, and I think there during the process we could see 2 views emerging. One was how to deal with the central bank own exposure to climate risk and the own exposure that they get through the monetary policy operation. And the second question was how and should monetary policy operation be used to support the financial system to fund the transition. And I think in this series, we've discussed these 2 topics. We've also presented several times some options that central bank could follow for both questions. And I think a good document for you to get a view of what everything central bank can do regarding climate in monetary policy operation is the document by the NGFS on monetary policy operation. I think and Dirk might correct me later, but I think from what we've seen from the outside, during the strategy review process, there was a lot of discussion on whether the ECB should support the transition through monetary policy operation, with very different views across the board, and also a lot of antagonizing views, I think. But however, I think on the other side, there was a consensus across board members that it was important to protect central bank's balance sheet from climate risk. And I think here, Weidmann said several times that it was the duty of central bank to keep in check the risks that they are exposed to, and especially and also including the climate risks that they are exposed to. So there was much more agreement between the members of the board, and I think we can see that in the measures that have been announced by the ECB. A lot of measures go in the direction of managing climate risk in the ECB balance sheet. Just to say three of them, they've decided to enhance their risk assessment capabilities, including by using new data or developing or improving existing data. They also announced that they will reflect climate risk in the collateral framework and also to a lesser extent in the corporate sector purchase program. So that's what I've been said last week, but I'm really happy now to turn to Dirk, who will give us a probably more profound presentation of all of that, and also give us his reflection about what central bank can and should do in terms of risk management. Dirk is a senior financial risk manager at the financial market division of the Nederlandsche bank, the central bank in the Netherlands. He's also a full professor of finance at the School of Business and Economics of Maastricht University. And he is a former executive member of the International Organization of Pension Supervisors, and finally has served as a fellow at the Financial Stability Institute of the BIS. Dirk, it's a pleasure to have you here, and let me turn the floor to you. And you are still muted.
Thank you, Pierre, for this kind introduction, and also thank you for inviting me. I think you came across one of the papers I wrote on this topic in the Journal for Risk Management for Financial Institutions. And so what I will be talking about today is mainly the ideas that I floated in that paper. But obviously I also refer to the developments at the European Central Bank and also at the Dutch Central Bank.
Dirk, can I just interrupt you, because I just realized I forgot to launch a series of questions that could help introduce the topic as well. I'm really sorry to have forgotten that. Yes, here they are. So 2 questions for you, the audience, and then you can bounce back on their answer in your introduction. Sorry for that. The first question is: does fundamental uncertainty over climate change impacts warrant a precautionary approach to financial risk management at central banks? And the second one is: which strategy would you choose to mitigate the climate risk in assets held by the central bank? So I will let a few seconds for people to answer, then we will see. So the answer for the first question is yes, the economic impact of climate change is still largely unknown. No, we have to wait for climate-related data to calculate the risk. No, we know enough about climate change impact to calculate financial risk, or we don't know. And regarding which strategy, first is restrict the eligible universe based on environmental screening to only buy assets with the bounds of climate-aligned benchmark, and only buy assets from firm disclosing climate risk, or apply haircuts. So maybe we can see what are the answer now. So for the first, so a very unanimous response on the first one. Yes, a precautionary approach is warranted because climate change are still largely unknown. And regarding the strategy, more broad views. One is the one with the largest vote is only buy asset for firm disclosing climate risk, which is what the ECB has come with. But also some votes on restricting the eligible universe and only buy asset within the bound of climate aligned benchmark. So sorry for this, for jumping in before you start, but happy for you to react on this question and to present your work. Thank you.
Thank you, Pierre, and no worries. Actually, I got an interesting pop-up saying that I couldn't vote. But I think it's great to see that there was already a vast majority in favor of applying this precautionary principle. So that's very interesting to see. Actually, I didn't expect that. So that's interesting to read. And also
maybe something for us to present in more details next year.
Yeah. And also interesting to see that there's quite a balanced view on the different instruments that can be used in working with climate-related risks in risk management practice. So let's go to my slide deck, if that's okay, Pierre. And yeah, you already mentioned in your introduction that obviously last week was important for the European Central Banking community, because the ECB, or the Governing Council, announced its action plan regarding climate change and monetary policy, together with colleagues from the ECB and also from the DNB. I was involved in preparing the decisions by the Governing Council. And I was pleased to read the announcement. And here on this slide, you can see concrete measures that are being taken to address climate-related risks in the monetary policy operations framework. And so to highlight four key elements, so there will be disclosure requirements as an eligibility criterion for private sector assets. The framework for the corporate bond purchase program will be adjusted to incorporate climate-related risks and criteria. The collateral pool, in terms of valuation and risk control measures, will be adjusted to reflect climate change-related risks. And obviously, also the European Central Bank will conduct a climate stress test, in particular on the euro system as a whole. So I think these are this is great news. This is an important step for the ECB, for the euro system, and I think it also strikes a balance between being proactive and decisive on fighting climate change, but also to do that in a way that that all the necessary preparations can be taken in a orderly manner, and also that the market can adjust to this. So I think this is great news, and yeah, over the next few months and quarters, we will work on really implementing this. And as Pierre already mentioned in his introduction, so there are two ways to look at this. So on the one hand, you can think as a central bank trying to be proactive and to support the transition to a net zero carbon economy, and that the actions taken by the central bank are really supporting that transition. And the other one is more the risk management perspective, so more the protective approach, where central banks treat climate change as a risk manager, maybe even as a conventional risk management problem, in managing the risks on the balance sheet. Now today I will mainly talk about the protective approach, so more the risk management perspective, and how, in my view, precautionary principles should play a major role there. So let's look at the risk management perspective, and let's take a step back and take a more global perspective to start with. Because if we look at climate change, how it is currently happening, look at wildfires, look at the heat waves in Canada and in the US, it's really starting to show an impact on the earth, and therefore also on humanity and on the economy, etc. So how should we look at this from a risk management perspective? So normally as risk managers, we look at things like the probability of default and the loss given default, and the product of these two being our measure of risk. But in terms of climate change, we maybe need to turn our view more into that one of emergency. And in this formula, you can, or I show how this emergency is a function of risk. So risk is as I said, it's the product of probability of a bad event and the damage in that particular bad event. And while urgency is actually a ratio, in this case of the response time that we still have to take action, and the remaining intervention time. And this formula actually is quite intuitive, it's quite simple also, but it's quite intuitive in showing an important risk management principle, namely that we are still in control if the response time, in this case tau, is less than the remaining intervention time. And particularly with respect to climate change, which we think that has an impact in the long term, but we shouldn't await the impact. We should steer now to prevent climate change to have a draconic impact on the earth and on humanity. And that's why governments in the first place are taking action, but also actors in the financial market should play a role in that, and therefore also central banks, of course. Now, because it's obvious that, and I can show you a lot of metrics and tables and figures, but if we translate climate change into economic metrics, in this chart you can see the ratio of the economic damage in US dollar versus the number of droughts, extreme weather events, wildfires and floodings, etc. And you can see that there's an upward trend in the economic damage from climate change, and also that the volatility is increasing. So there are sometimes extreme outliers that we didn't foresee, but that do have a major impact on, for instance, global GDP. And again, looking at the heat waves in the US and in Canada, where the extreme temperature is all of a sudden 5 degrees Celsius higher than in previous heat waves, is something we need to prepare for or anticipate, and that these extreme events can happen all of a sudden. And as I said, global governments are in the lead in this, in fighting climate change. And obviously one of the important measures that they should take, and that they are taking, obviously, is the pricing of greenhouse gas emissions. And in this chart from the World Bank, you can see that there are numerous initiatives to indeed start taxing carbon emissions and other greenhouse gases. But unfortunately, it's also it's quite insufficient yet. So although, let's say, 21% of global greenhouse gas emissions by now are priced, the price itself or the tax itself is quite low. So only 1% of all these initiatives is actually aligned with the Paris Agreement. So this is actually, we can now predict or expect that this will definitely be increased going forward, and it's also really important that this is increased over time. Now, governments play a major role, but I also think and believe that financial markets can play an important role to allocate these risks throughout our economy. And although these instruments do not exist, I think there is a clear case for governments, for instance, to issue climate-related bonds. Yes, just like they issue inflation-linked bonds, they could also issue climate-related bonds for which the notional value is linked to the realization of some climate-related metric. And once we have climate bonds issued by governments, we can also build derivative markets and climate-related swaps, where counterparties exchange the realization of a climate-related metric in return for a fixed rate which is agreed upon upfront. And just to give you an example, similar to CPI, you can also think of a broad-based average of, for instance, the atmospheric greenhouse gas concentrations to be a metric in such a climate bond. And then we can actually, investors can ensure their exposure to climate change. And I think even more importantly, we will also have market information on what the view of the market is with respect to climate change and climate change risk. And to make that more concrete, let's look at the idea of a climate swap, where we have two counterparties where they agree to exchange cash flows, and counterparty A will pay a fixed rate, which in this case lambda, and lambda is, for instance, what I just said, so the greenhouse gas concentrations in the air, to counterparty B. So this fixed rate is agreed upon upfront, while counterparty B will pay in return the realized rate, let's say after a number of years. Now, traditional finance arguments will say that at the inception of the swap, the cash flows will have equal value. But these cash flows, at least the realized rate, of course, is stochastic. So the present discounted value of the cash flows should be equal at the inception. Now, we don't go through the math, of course, in this presentation, but if you do the math, you can see that the fixed rate in the swap is a function of the expected greenhouse gas concentrations in the air, plus a climate risk premium. And we know from finance that key in this climate risk premium is the covariance between the stochastic discount factor, capital M, and the future atmospheric greenhouse gas concentrations. All this is very similar to inflation-linked swaps. And if we would have bonds and climate swaps, we would be able to infer what the market's view is on future expected greenhouse concentrations, and also what the climate risk premium would be. And so again, I think governments play an important role in climate change, but also financial markets could play a major role in trading climate risk and also pricing climate risk. Now let's turn to risk management, because my talk should be on risk management and not on climate swaps. But to really understand what we should do in risk management, we should also understand the concept of risk management. And so there are some important concepts that I first would like to introduce to you, and which I'm quite sure you're all very familiar with. And so when we talk about risk, We typically talk about the situation where we have a model. So there's no model uncertainty, and we also know which parameters we should use in our model. And risk in a very pure sense is the stochastic variation within a model that describes reality, and the model contains parameters that also are representative of the reality. Now, of course, this is a very ideal situation, and in practice, we are quite uncertain about which model to use, and which model truly reflects all future states of the world, and also which parameters we should use in our model. So this is definitely something which we address, and which we also can address in normal risk management practices. However, when we talk about climate change, it's more in the area of uncertainty. So we don't have the right models to describe the future developments with respect to climate change and the impact it will have on our economy, and let alone that we know the parameters that we should use in these models. And as I will show later on in my presentation, that also means that we need to be open to use other tools in our risk management toolbox. But let me first talk a little bit about risk and parameter uncertainty, and also a bit on model uncertainty, before I turn to the concept of uncertainty itself. Now, as I said, we will always be surprised by extreme events. And they will also occur when it comes to climate change. And actually, talking about climate change and financial markets, instruments that are really close to changing or to trading climate-related risks are cat bonds, catastrophe bonds. And you can see here the return distribution of a cat bond market index over a substantial amount of time. These are, by the way, weekly returns. So you can see that's a nice, almost normal distributions, and there are a few outliers here. But there was a big event in September 2017, when there was a -20 standard deviation return in this cat bond index. So I'm not sure if you can see it, but all the way on the left there is a small negative return of almost -17% on a weekly basis in the cat bond market. And this extreme event was actually created by Hurricane Irma, which entered the coast of Florida in September 2017. So apparently, this is actually very strange, so because a hurricane, you see it coming, and you see it approaching the shore, and actually at the moment that it hit the coast of Florida, it caused this big event in cat bond prices. And actually it cannot be described by any distribution that we know. So I was referring to a normal distribution, or even fat-tailed distributions like a student T distribution or power laws. Such an extreme event is very difficult to capture in traditional models. But the good thing is that we can learn from these extreme events. So we can update our models, we can update our parameters over time when these extreme events happen. And so that's actually what we can do with this information. So we can see how we need to update our risk distributions, our return distributions, and how it will impact our traditional risk measures. And then in that case, we are particularly interested as risk managers in the left tail of a return distribution, and how such an extreme event can impact the return distribution. And to make that more visual, look at this chart where I zoomed in on the left tail of the return distribution. So this orange line was the distribution before an extreme event, And once there's an extreme event, the whole distribution, at least the left tail of the distribution, moves further down to the left, and it will impact our risk measures. Yeah, so we typically look at the probability of an extreme event, let's say the probability of an extreme loss, X in this case, and also the amount or the size of the loss once such an extreme event happens. So we actually did some math on the impact of Hurricane Irma on the return distribution of cat bonds. So what we did is we looked at a full period before and after Hurricane Irma, and then we also looked at the full period. And here on the left-hand side, you can see some risk measures like standard deviation and also lower semi-standard deviation, and the value at risk and the tail value at risk, and also this psi risk measure, which is just the probability times the t-value at risk in a certain percentile. And you can see that this single extreme event has a huge impact on the risk measures after Hurricane Irma hit the coast of Florida. And so it really blows up all these value at risk and tail value at risk measures. And also, if we look then at the full period, we see that the return distribution has really shifted just by including this single event of Hurricane Irma. And so in the traditional sense of risk managers, using models, using parameters, using return distribution, using actual evidence of the impact that climate change can have on financial markets, we can update our models over time, and we can also update our risk figures over time. But the drawback is that we need to wait for these extreme events to happen. And I think we should have a discussion whether or not that is sufficient. And what else can we do to anticipate this? And what else can we do to incorporate the damages of climate change before we actually see the evidence? And that's where we come to uncertainty and also to incorporating the precautionary principle in risk management. And so my view is that climate change is to a large extent uncertainty, fundamental uncertainty. We are uncertain how the magnitude and impact of greenhouse gas emissions and also climate policy will be on the economy and on the financial system. And there are many unknowns. I won't go in detail on this because I'm also not an expert in climate change science. But we all read reports and studies referring to feedback loops, tipping points, non-linearities and interactions, etc., that are largely unknown to us. And so think of the ice cap on Greenland. We know it's melting. We also know it's melting quite faster than we anticipated, like 20 years ago. It will mean that sea level will rise. It also will mean that sea level will absorb more sunlight, which adds more to the increase in temperature, etc. And this might lead at some point to tipping points where there might be all of a sudden a huge impact on climate, on the earth, etc. And now what's interesting is, and I already referred to it a couple of times, so it's uncertain, fundamentally uncertain. And what is key to fundamental uncertainty is that we will be surprised. There will always be potential surprises by events that are not in our models, that were not described by our parameters, and which are also very difficult for us as human beings to capture. So we are, as humans, we are biased to the evidence that we have learned in the past by focusing and searching for information that confirms our view of the world, etc. So we need to be aware of that, and we need to be aware of potential surprises that can happen to us and to financial markets. Now, how should we deal with that in risk management? In addition to using models and parameters to understand the financial consequences of climate change. So I'm not advocating that we also only should look at uncertainty. We definitely should also look at the more traditional risk management models and approaches. But I would like to spend the rest of my talk on focusing more on how we should deal with uncertainty in risk management. Because in the end, you want to be less vulnerable to these potential surprises. And how can you do that? And I think you can do that by approaching this uncertainty in a structured way. And I think actually the normal risk management cycle is really applicable here. So you try to identify these uncertainties, to make an assessment of the uncertainties, to take mitigating actions, and to monitor all this, and also to disclose on the outcome of the assessments that you made. So let me go through each of these individual elements in this risk management cycle. So the first is identification. So how can we identify potential surprises when it comes to climate change? And these are maybe less traditional approaches. Now, one interesting development is what I call expert elicitation. So what we need to do is to work together with experts with different backgrounds. We need to talk to climate experts, science experts, financial experts, biodiversity experts, etc., to really understand what are potential surprises that we face. And one interesting tool to do that actually is to do large-scale internet surveys. So you can ask a large group of experts specific questions on future developments. And what we know from statistics is that you ask a large group of experts, that you will actually have a very decent representation of these future events and also the future distribution of risk factors. Because the wisdom of the crowd will lead to a better understanding what for instance, the expected value is of a future event. So that's one approach. Another approach is to be alert, actually. So to be alert to early warning indicators. For instance, to climate change related losses. Actually, you can not only apply this in the context of climate change, but also in other situations where it's not a lot of evidence, but we sort of have an idea where there might be potential surprises coming in the future. Think of cybercrime, for instance. And another tool, it's also non-traditional, but is to do a so-called pre-mortem analysis. A pre-mortem analysis is different from what a doctor will do after a patient has deceased. A doctor does a post-mortem analysis, and he tries to identify the cause of a death. But the pre-mortem analysis is actually to do something different, and what you do is that you imagine an extreme climate-related event. And so it's a fictitious event, it's an extreme but possible event. It's the catastrophic event. And once you have identified that, you sit together with a group of experts. And again, you need to think, to brainstorm, to use your imagination to brainstorm on potential causes of the catastrophic event. And you can do that from the perspective of your financial institution of your central bank. By doing that, you actually are able to identify what the key weaknesses is for instance, in your balance sheet. Where is the exposure in your balance sheet to such an extreme climate-related event? And that also gives you information on which risk mitigation actions that you can take. So this concept is prove to work in practice. We used it actually at the Dutch Central Bank quite often in supervisory issues, but it can be applicable to each situation where you face uncertainty and you want to have an understanding of the potential impact that these uncertainties might have, for instance, on your balance sheet. So that's the first step. Now let's turn to the second step. So after identification, you turn to assessment. And also here, in the area of climate change, it's also very innovative. We need to think of innovative ways to make an assessment of climate change related risks. And what I see if I talk to commercial banks and also to what I see happening at other institutions looking at climate change, that they are building risk heat maps. And you might use some data for that, but again, you might also use expert judgment to fill a risk map, a matrix where you look at the potential likelihood of a climate related event and the impact of such an event on the economic exposures that you have on your balance sheet. Yeah, so you can actually use colors in filling the risk heat map to identify which economic exposures in which sectors, for instance, are extremely exposed to climate change and which are less exposed to climate change in terms of physical risk or in terms of transition risks. As I just said, we can also use the models that we have in dealing with climate change and also updating these models and parameters once there's new information available. And thirdly is, of course, scenario analysis. Everywhere you look into and you read about climate change and risk management, you obviously will find examples of stress testing and also reverse stress testing. And as the ECB announced, it will also do a stress test. Now, maybe I will take 5 minutes or a few minutes to talk about the stress test we actually did at the Dutch Central Bank. If that's okay, Pierre, I see your camera turning up.
I mean, if you can, talk about 5 more minutes so we can have also time for questions.
Yeah, I will do that.
Thank you.
So we last year we did a stress test at the Central Bank, so at our own balance sheet, where we looked at a couple of extreme transition scenarios, or only transition risks, to really get an understanding of where the exposures are on our balance sheet. And these are the scenarios with respect to transition. So on the one hand, we looked at technological breakthroughs, and on the other hand, the intervention by governments with respect to carbon pricing. Now, I won't go into the details and also don't show you the numerical results. But in our first TCFD disclosure, which can be found on our internet, and I also put a link into the presentation afterwards, is that we did disclose the qualitative impact of these scenarios on our balance sheet in terms of the total risks that we are exposed to, and also the impact on the profits for DNB. And we showed that the double shock scenario, in which there is a strong increase in carbon taxing and also carbon taxes, and also in technological developments, will have the highest impact, negative impact on profits and total risks. Okay, so the third step, so we talked about identification, assessment. The first step is mitigation. So referring to the press release of the ECB, you will see that there might be ways to reduce the exposure to climate change risks, for instance, by imposing eligibility criteria on disclosure in purchase programs, by applying tilting in purchase programs, and for instance, also by applying haircuts in the collateral framework. In addition, you can also think of setting tolerance levels and to also prepare contingency planning. And so what actions you can in advance think of actions that you can take when certain events happen, so that you are sort of prepared for these extreme scenarios. And as a sort of an overall guiding principle, you can do that in a sort of precautionary way. So what do I mean by that? A precautionary principle means that you anticipate and also minimize the potential serious impact under conditions of uncertainty. And you can think of that as a hedge. So these stronger prevention measures taken today are actually a hedge against the cost of extreme measures that you will have to take otherwise, in terms of if an extreme scenario happens. So it's a hedge against the cost of draconian interventions at a later stage, which might occur if these extreme events are not appropriately covered by the models that we use. Okay, so I'm almost done. So the fourth step is disclosure. I think that's also key. So central banks and other actors in the financial markets can and also will disclose material information on the exposure to climate-related risks. And I think this is important for not only for meaningful decision making, but also to be proactive and also to stimulate other market participants in developing their own best practices, in creating incentives for market solutions. I was already talking about climate bonds and climate swaps, and also in improving price discovery in financial markets. So briefly, very briefly, as one of the things that we already did in our most recent annual report is to disclose the carbon footprint of our non-monetary portfolios. You can see the numbers on this slide. You can see the carbon footprint in terms of the enterprise value, but also the well-known WACI, the weighted average carbon intensity, weighted by the turnover of companies that we invest in. Okay, so let me finish, and then we can turn to the Q&A. So my main point is, so we definitely need to use the traditional risk management tools. So the data-driven tools, the models that we use and that we have. Be aware of parameter risk and update the risks in our models when we have more information on climate-related events. But we should also think of more new tools that we can apply in our risk management toolbox, like expert elicitation, pre-mortem analysis, obviously stress testing, risk heat maps, and all the risk mitigating measures that we can take, and which are often quite concrete in terms of eligibility requirement, tilting, and other measures. But also think of contingency planning, so to do an ex-ante analysis of what extreme events we could occur in an extreme but plausible scenarios, and which scenarios and which actions we would actually take in these extreme events. Okay, thank you, Pierre. That's it. Back to you.
Thanks very much, and I'm very happy that you could also present what the precautionary principle is in terms of risk management for central banks. You've seen that there is a lot of interest on it. For the audience, you can ask your question in the Q&A section, or also raise your hand if you want to speak. Before that, I have a few questions. One is related to, shifting risk management from risk to uncertainty. I think you explained to us very clearly why it is necessary in the case of climate change. What is your feeling about how financial institutions are on this road? Do they already have shifted to this uncertainty paradigm, or are they still working with traditional risk, well-known risk like a paradigm? And also in terms of central banks, central banking, is it also something that you think is taking traction, or are we still living in let's say, a very secure risk management strategy? And before that, I might, if I can ask maybe Torsti Silvanen, who is in the room, to give also his what he thinks about what Dirk presented in the context of the ECB and what they've planned. I mean, that could be great as well. Thank you, Dirk.
Shall I respond, Pierre?
Yes, please. Yeah.
Okay, so I think that's a very good question, and it's also a very fair question. I think it's not necessarily a shift. I think you should do both. You should definitely use traditional risk management techniques in terms of quantifying risks. And I definitely see a lot of traction in the world of financial institutions and also in central banking to really work with these tools and also to develop these tools. And I think so I think more, let's say the uncertainty principles is more like an addition to that. So it's both. And as I said, I think the key is that we will be surprised. We will be surprised by events that we didn't foresee. I hear many people talking about climate change as something which will happen gradually over time. We don't know that. I can give you many examples where we were surprised by an extreme event all of a sudden, like for instance the heat waves in the US and the extreme impact they have on the distribution of the temperature is in maximum temperatures in these heat waves is not described by any model. But you might want to think of, can we anticipate that? And so when the new toolbox is more like, how can we add to the existing risk management techniques in being more prepared, being more robust to these extreme events. And I definitely see also more and more traction on these kinds of approaches. And for instance, stress testing, I think everybody is by now looking into building climate-related stress testing. And definitely the scenarios and the work of the NGFS will help the financial community and the central banking community in doing these stress tests in a very professional way.
So stress test is something that has been advocated for by a supervisor now for a long time. And I mean, you started first at the DNB, but now you also have stress tests at the European economy-wide level. So you think stress tests could also be a tool that could be used by central bank to manage their own portfolio, not only to look at the stability of the financial system?
Yes, absolutely. Yeah. So actually, that's what we did at the central bank. We really we did a stress test on our own balance sheet, including all the monetary portfolios and also the non-monetary portfolios, and had to really look at the impact that in different scenarios, how the GDP will develop, how interest rates develop, how financial equity markets will develop, and really translated that all the way down to sectors, financial sectors, the different sectors in the economy, and also to the different issuers and companies that we have exposure on in all these different economic sectors. I think it's fair to say that in the end, our profits and risks are mainly driven by interest rate risk and less to, let's say, specific exposures to individual companies and issuers. with respect to a few sectors that are really hit by these technological developments and also by carbon pricing. But the tool is definitely also applicable to a central bank balance sheet.
So yeah, if Torsti, Silvana, if you want to give your take on what was just said for, yeah, perfect. Thank you. So I would be happy to, yeah, we can hear you. And we can see you.
I don't know what's the picture behind me, but no, I think
it's great.
Thanks for Dirk on the paper, and thanks Pierre for asking. Dirk is an expert on long-term risk management, but what I like on the paper is that climate change is inherently complex. So it's useful to focus on one aspect, and here we have this fundamental uncertainty and risk and how to define emergency on something that is very gradual. So I think this always benefits the overall discussion and brings a new aspect. There's one common denominator which is often in discussion. It's the data measurement and data techniques. But what Dirk shows, it's developing very fast, and what we're trying to do, and we work also with Dirk together, is a kind of capacity building on spreading this information and learning from the latest data. What I find also interesting was in Dirk's paper, there are 27 references, and they are all done within 5 years. So there's a lot of information coming up. One example is what's in your paper is that new data techniques like satellite data and current emissions. That helps to increase awareness. I remember reading just last week about the Australian coal mines, which emit methane worth 30 million combustion engine cars. So it's no longer that simple to hide these things. But at the same time, when one thinks of risk management measures, you also have to think that there are new techniques to catch methane, for example. So it's not very clear that in the end what works and what not. And I think it's really important issue when one considers the actual measures to think clearly what do you want to achieve, because there are always trade-off. And if you purely think of the risk perspective, well, you can mitigate a lot of risk, but then you lose on return. And this Dirk probably knows that this is nowhere as clear as in the US pension fund industry, where the fiduciary duty is still defined as financial performance. So at the moment, I think it's still in most of the states that you can't take the risk aspect if you end up losing in financial performance. And therefore, this is a useful aspect, but one then needs to think really careful that what do you in the end put in place as a risk management measure, and what does it cost? Normally it costs to be virtuous, and lately there's been more discussion that whereas it was thought that if you are conscious on environment, you always end up profiting from it as well. But in the end, I see it more on the longer term, like the investment grade versus high yield market, that we have a ESG ratings and this transition and the physical risks taken into account with issuer risk. And then you have two different groups. But in the high yield browner issuers, you have also higher expected return. So that just shows that you can't get it all if you mitigate your risks. But overall, I think we have a lot to look deeper with Dirk. This is a very good framework, how he explained it to dig deeper. Thanks.
Thank you very much. There are a few questions in the Q&A. One, so do you think do you think it's important to distinguish between physical climate risk and transition risk when you a central bank for that? I mean, do you recommend having different tools or taking different approach for both of them, or is it the same? And I'm just collecting a few other questions, and you feel free to answer the one you want. There is also a question about, do you think that central bank have to recalibrate all their model for central bank, or can they still continue to use some of the risk management tools that they have? And also another question is, what is your view about the maturity of climate data and models, and especially since we have different providers of risk metrics, for example, how much you can work with these providers and aggregate these results. I mean, just feel free to rebound on one of the topics that I just mentioned.
Yes, thank you, Pierre, and also thank you, Toto, for your kind words and supportive words. Yes, the distinction between physical risks and transition risk obviously is important because they are both a risk. So we definitely need to assess them both. In terms of stress testing, so I mentioned that last year the stress test on the balance sheet of the Dutch Central Bank really focused on transition risks. We're now looking into a possibility to expand the stress test by also including physical risks. And this is really challenging. So we need to think of how to translate a scenario, for instance, from the NGFS, in terms of what the impact will be on physical risks that we have with regard to the different issuers that we have in our portfolios, and even with respect to the exposures that we have on governments, on sovereigns. So definitely this distinction is necessary and also something we are currently working on. Actually, going back to one of the points raised by Toto, on the one hand, and then zooming in on the non-monetary portfolios, we obviously want to make a return with these portfolios, but we want to make a return in a sustainable way. So if we look at developments within DNB regarding the non-monetary portfolios, we are really looking into how can we balance these two objectives at the same time. So going forward, we expect to have a dual objective where we both say we want to invest in financial markets for return reasons, but also to do that in a sustainable way, or actually to contribute to sustainability of the economy. Maybe one word on models. So an interesting thing that we learned in our previous stress test, and I think which will also you will use in our upcoming stress test, is that we can use our normal risk models when we want to make an assessment of credit risk or market risk or interest rate risk. And so in this top-down approach, where we start from macro scenarios on climate change, on GDP, and all the way down to different sectors and issuers. In the end, we could use our existing credit risk model, for instance, to make an assessment on the impact of climate change on credit risk. So that was good news, but obviously we're also thinking on whether or not we should update these risk models specifically for incorporate climate change. And I think that's an interesting question. And I think the debate is still open. I see quite some reports referring to the view that climate change feed into traditional risk factors, for instance, credit risks, and that we do not need to build specific models for climate change risks, but that we maybe need to update the credit risk models. Or are we going to use them as a more separate risk category and build specific risk models for climate-related risk? I think the debate is open there, and I definitely will see some developments there over time.
Maybe two last questions if you still have time.
Yeah.
So one for myself, actually, in the beginning you really showed us that the urgency, so there's like an urgency metrics. How much time do we have until we take the decision and until the shocks are happening? For climate change, and central banks. How much time do central banks have before turning policy into action? And asking that because there is a lot of question about the ECB timeline, about what they have announced last week, and saying that they should be faster given the urgency. So what's your view on that? Is it possible? Isn't it also a precautionary principle to act fast and then maybe recalibrate a bit later? And the second question, which I take from James Vaccaro, but I reinterpret it a bit myself, and it's maybe more philosophical question about risk management. So should we, are central banks and financial regulators also responsible for managing the contribution to systemic risk and to climate risk? So, for example, from a financial supervisor perspective, one way to manage risk is to foster the transition so that we stay in a world where risks are lower than a hot house world where you have a lot of big risks. So that would kind of support preemptive action from central bank supervisors. So what could be your take on that? And feel free to pass the question, to not answer the question if they are too sensitive to do that.
Yeah, so let me try, but maybe Toto also wants to add on this, on your question on the measures of the ECB. I think they are great. I think they are also timely. I also think that this is a really important first step. I think they are proactive and decisive, and I think it's also presented and implemented over time in a way that we can do all the preparations that are necessary to do it in an orderly way. And both Toto and I can tell you that we're really working hard on this, and also that the market can also adjust to this. And I think it strikes a balance between these two dimensions. And I think, supportive. So indeed, I think if we look at supervision, we are pushing for the awareness of climate change and the impact it can have on financial institutions for quite some time now. And to not only for these financial institutions to be aware of the impact it might have on their business continuity, but also the responsibility that they have in contributing to a transition to this net zero economy. And I think it's a collective action of all actors in the financial industry, in financial markets, to support that transition. There's also for the central banking community.
Thank you very much, Dirk, and also thank you for answering over time. Let me conclude this last seminar before summer break by reminding you that on the 31st of August, there is the official launch of the e-Access Forum that I announced in the beginning. Feel free to visit the webpage to register for this launch event. And that being said, thanks a lot for having followed this series of webinars over the last year. Thanks again, Dirk, for this very inspiring presentation about managing climate risk in central banks and in financial institutions in general. And let me.
You're welcome. It was my pleasure.
Thank you very much. Thank you. And that being said, let me wish you a happy day or evening after this seminar. Thank you very much. Bye-bye.
Bye-bye.